Well, welcome back, friends, to Behind the Capital Curtain. As you know, this is pulling back layers of complexity in the world of business and commercial real estate deals to reveal what really drives top-tier investment opportunities. Hosted by me, your friend Dave Cotter, and the show explores the art and the science behind investing in exceptional businesses and commercial real estate deals. Each episode is a deep dive into the structures, the strategies, the secrets that make standout investments successful. And I'm really excited to have our guest here today, Garland Benton. Garland, thank you for coming on the show today.
Hey, I really appreciate you having me on, Dave.
And I'm going to give a little background. Garland serves as the Director of Business Development at Direct Equity Source, bringing over 25 years of experience in private equity with a specialization in oil and gas and real estate. After attending Northern State University in Oklahoma, Garland began his career in the early 2000s with the largest oil and gas broker-dealer firm in the U.S. Over the course of his career, he has been involved in more than $500 million worth of asset acquisition and served both as a limited partner and a general partner in projects spanning from multiple asset classes. He's also an accredited investor himself, so he's in the seat. Garland is personally invested in private placements, syndications, businesses, and startups, giving him the firsthand experience into opportunities and challenges faced by investors. His focus is on helping others build long-term wealth through passive income, with a strong emphasis on diversifying portfolios beyond the traditional EFTs that we all see. Today, he's passionate about educating investors on the value of self-storage and small bay industrial business park investments. Big fan of both of those. For tools for wealth creation. So excited to have you here today, Garland. And I'm going to dive right in and just ask you, what are the benefits from your perspective? Because I've been involved in self-storage for a long time, of just ground up self-storage. Walk the audience through that.
Sure. Try to simplify. Obviously, as you know, from being out there in the marketplace and going to various events and being an investor yourself, you see there's multiple ways that you can get into self-storage. And I do believe the variety of ways all have a benefit in their own right. I don't think there's a wrong way to get involved. I just think storage is very recession resilient. So having a part of your portfolio on it makes sense. Then you go into the step, well, which direction do you go into? The ground up self-storage, retrofitting, value add, multitude of ways you can get involved. What we focus on through our sponsor is ground up only self-storage.
Huh.
And we feel the benefit is all comes down to the cost basis, just to make it very simple. And I use as an example, somebody that's buying one of our properties. We appreciate these people, but these people are buying our properties with around a 5.5% cap rate.
Wow.
They're fully dependent on going and increasing doing whatever marketing solutions they think they can increase occupancy rents, variety of ways they can increase revenue, but they're walking in essentially overpaying or paying a retail price to acquire properties. So that's great for me because I can go in and build these in an actual lowest cost basis,
Yeah.
physically possible. And I just think that gives you a huge margin. I think when you look back to no farther than 2008 or any of the other down markets in real estate, I think that becomes very important. The lower your bases of entry is just simply giving you more for the unknown that lies ahead. And so that's why we choose to focus on the ground up. So our entry model and exposure is at the bare bones bottom. So there's really only one way to go from up, if that makes sense.
Makes total sense. This matters big time, and people are experiencing that in this market when people overpaid in 2019, 2020, and it didn't really matter, but they're just way overbuilt on it. So completely agree with that. And I guess on that same vein, there's a lot of different groups out there doing self-storage and doing syndications. And so what makes your fund unique? What's the USP?
Sure. So as you kind of mentioned earlier, I've been in the syndication arena for 25 years now, since 2000. And so I've seen just about every possible structure that you can have for a syndication and model, and have really taken from some of the best ones that I've ever seen
Mm.
and use the worst ones that I've ever seen as learning curves and how to create a fund that is truly investor friendly and aligns with investor interest. And I don't think there's a way you can get there just by educating yourself in the short term. I do think it is something that you learn over time. You know, you look back on your investments, what worked the best, what didn't work the best. And so you can kind of draw from that, from past experience. And so we've created the current model to stand out. As you said, there's a lot of people out there and a lot of ways you can get into it. I think our fund's very unique, drawing from those past experiences, in that just some of the key points that we put together, what you see with syndications, the number one issue I see is liquidity. Typically when you do a syndication, and this goes across every sector, this is not just storage related. Syndications in general, what I find, whether it be oil and gas, multifamily, RV park, storage, I kind of lump them all together. You see, typically you're in there for 5, 7, up to 10 years. It's
Huh.
just kind of a long-term play, and there is no clear-cut design. How do you get your money out if you need your money out or if you want your money out? You know, let's just say you as an investor in there, Dave, 4 years down the road, you have some medical issues, and you know, you call up the company and say, you know, I have 250,000 in that. I'd really like to have my money back. I don't know if you've ever tried that, but it doesn't work like that in a syndication. You sign the documents,
Yeah.
you put your name on the line, you're in there to the end, whether again, 5, 7, 10
Yep.
years. And so that was really the number one thing I addressed. So our fund's unique that I actually have it in the contract, not just a verbal, we'll try. It's actually part of our agreement with our investors. All we ask for is a 24-month hold period. If you come to us 24 months after your initial investment, anytime thereafter, we'll take you out of the project at your original investment amount. This is
Huh.
not a commission deal. There's no penalty. There's no early exit fee. We provide that liquidity. You get to keep all the returns that you've made up to that date, and then you get cashed out at your original investment amount. So the feedback from my investors on that has been just very, very, very positive.
Uh,
Probably the biggest change that we've made to this syndication that we've never been able to offer before is that liquidity event. And that's a big deal, I think,
yeah.
especially when you're not typically putting in just a couple of thousands in these syndications. People are putting
Yep.
larger chunks of money, and that's just nice assurance that that's there for them if something happens in their life and they need it.
It's a very unique thing and beneficial for people, this liquidity factor for sure. Let's talk about diversification. Obviously, that's something that most investors have generally heard about. How does that play out, and how do you use it in your particular portfolio? Because diversification matters. So I'd love to hear your perspective.
Sure. I think it all goes back to the past experiences, what works the best, what doesn't. A couple of reasons the driving factor in here makes the most sense for us to be diversified is, again, you look at past syndications, what a lot of guys out there offer. They'll take your entire investment dollars and they'll put it on one property. That's, to me, comparing that to, would you take your entire investment portfolio for the year and put it on one stock?
Uh,
If that stock does well, you're looking pretty good, right? But how often does that actually happen? And look at the most successful investors in the world. Do you know any of them that just take all their money and put it into one at a time? No, diversification has always been the key fundamental going back to any type investment. And so
uh,
we really took that and wanted to apply that to the fund, because there are people that'll do single property syndications, and that's great. Our approach, we have typically between 20 to 30 properties in each fund that we offer. Not only are they geographically diversified amongst different areas of Texas and even Florida, the Carolinas. So you've got some geographic diversification, but even beyond that, I believe our current fund has 17 climate control storage facilities, and we've got, I believe, 5 or 6 of the small bay industrial flex space park. So you're
uh,
diversified within types of approaches in storage and geographically. So that's
it's
our
helpful.
reasoning on that is to spread the dollars around. All these things are also coming to fruition at different times. So again, if you're in a project for a few years, you're not just sitting there in a single property syndication waiting 5 years to build something or buy it and value add and turn it around. Being diversified across this many different projects, there's just always some kind of event going on that's creating additional income for the fund, if that makes sense.
Makes total sense. And I guess the other question that I'm sure a lot of people ask and are asking as well is you're raising money, you're getting people to put money into this. Do you guys have quote unquote skin in the game? And what I mean by that is, are you actually putting dollars in yourself? Do you not? How do you guys approach that perspective?
Sure. Love that question. And I don't think enough investors ask it, to be honest with you. I think it's one of the most important aspects. Bar none. Again, look over your entire lifetime of investments and what works out best for you. Now, I will tell you, I've had some investments that some operators put some money in the deal and they didn't work out. But at least
Sure.
we were in that battle together.
Yeah.
And you could truly say that their interests were aligned with mine. But that is, believe it or not, very, very rare in the investment world. It's just not recently. In the investment world in general, it's always that motto of other people's money.
Yep.
And we wanted to get away from that model. So like in ours, for example, we're putting in between 20 to 25% of the
Mm.
total equity cash. Our sponsor is putting in that on every single deal, not just this particular tranche of money, but every single project that's put
That's great.
together, putting up 20 to 25% of the capital. So like this little tranche, I believe it's a $40 million venture. They're putting up 10 to $12 million of their own cash. And that's at the investor level. There's no
Mm.
class A shares, class B, treated differently.
Yeah.
Everybody's at the exact same sharing agreement. That's the actual cash invested on the front end. And I think that is significantly different than anything out there. My investors actually, part of my background's due diligence, and I look at deals for
Hmm.
investors every day. And not as a financial planner that's going to steer them in one direction, completely independent. I participate with them on deals I like sometimes,
Yeah.
but my investors are bringing me projects almost on a weekly, sometimes daily basis and saying, hey,
Mm.
can you look at this deal? And the number one thing that jumps out to me is that sponsor will put in 0.5%, maybe 1%
Yep.
of the actual capital needed while the investors are taking 99% of the risk.
Yeah.
And, they have a great story, in a glossy document that, oh, we've got, sweat equity in this deal. Oh, we've worked 2 years to bring it to the table. Well, they're getting paid back for anything they've got in it and then actually go forward. And they're putting up very, very little, if no money. So the investors are bearing the brunt of that risk. And that's
Yeah.
very common out there, as you probably have seen.
Very, very much so. Couldn't agree more. It's a
And I
good.
don't think enough investors ask that. They just get
Oh
caught
yeah.
up in the numbers,
Yeah,
get
for
along with
sure.
the person trying to push them into the product, look at the glossy slides of how great
Hmm.
everything's going to be, but they don't want to ask the hard questions of, you know, how much are you putting alongside my money?
Yeah. What is your neck on the line as well? It's a great question to
Yeah.
ask. So you've been doing this for 25 years, and we all have what I call wisdom wounds, where we've gone through and we've had good experiences, bad experiences, things that have gone well, things that have not gone well. When you
Sure.
zoom out and look at the patterns of winning deals, what do investors, I guess, understand that it's too late to find out years later? What are some of those lessons that you've learned over the years about investing that you would say?
Sure. No, again, great. Can't get overlooked enough. It really goes back to kind of what we've been talking about this whole time is if you do the due diligence on the front end and you
Uh-huh.
ask the tough questions that may make them uncomfortable, it's
Yeah.
okay. It's your money. And I think probably personally speaking, I've gone into a lot of deals literally because a friend said, hey, I did
Mm.
this deal, I like it. And I would just participate, as a friend or try to be supportive without really looking into the deals. And I see that happen a lot through referrals that they joined into a deal without doing your own due diligence. And I think any type investment, it really goes back to asking, it's kind of a checklist of about 5, 6 things on the front end that I go through investors
Mm.
to ask. And while they're super common sense, people don't like to make the person on the other end of the phone or in person uncomfortable. So they just
Sure.
kind of skip over them. I think from my own experience, that's if I could change anything, it was asking those tougher questions on the front
Yeah.
end, as we kind of spoke about how much money have they put into it at their own risk. Another one important one is how many times have they actually done it? As you probably seen from traveling around and being in the investment world, so many companies have popped up over the last 8 to 10 years. From the real estate side of that, I always wonder, well, you weren't even in it in 2008. So you, in essence, you've never had a down market to experience.
Yeah.
But you see so many companies 8 to 10 years old that have not done full cycle deals, or maybe just a couple full cycle deals. So it really kind of sets off my red flags of you haven't been through it enough to experience the good time and the bad. That's another big stickler with me is trying to find out how many times have they actually executed this exact model to success or failure, good, bad, all the above. And that one again, people get caught up and just like today, it's so easy to make pretty brochures with all the
It is.
internet today. Everyone can pop out a beautiful deal and
Yeah.
they just don't ask about the history and the track record enough either.
I was talking with a fund operator the other day, and he was talking about ground up versus value add. He's like, it just
Mhm.
seems like the ground up have worked better versus value add. And I said, well, you're maybe right on that. I said, but do you think possibly it's more around the sponsor and then their basis? He's like, yeah, I guess that's a good point. I said, because sponsorship has the foresight, if they've been full cycle enough times, to see what's going on and to be able to work through it. Versus if somebody's new and just went to that weekend thing and got excited and went and jumped in, they just don't have the pair of eyes to understand what's going on and how to discern through things and making decisions that have wisdom oriented to them as well. So there's something really big about due diligence, and it's also boring. So most people don't want to do it and they don't want to have those tough discussions, but it's something you got to stay disciplined, because otherwise you're going to pay for it later. I just tell my
You
kids, I'm like,
are.
pay now, play later, or play now, pay later. But either way you pay.
You are, and
So,
I think you said that, exactly right. It's, whether it's ground up or value add, I'm not gonna sit here and say ground up's the best way to go. It's what our sponsor has done for 32 years
mm,
and has worked very, very well, and so that's hard to argue with, but I'm not gonna say that's the only way to go. I think
yep,
more importantly, it's you said it exactly, it's the sponsor, because we don't have enough time to cover it all today. We'd be here all day, but
yeah,
I have seen so many deals lately actually as opportunities to buy
yep,
of small little construction companies. I mean, building a storage facility is not rocket science, right? I
yeah,
mean,
right.
you can get it done if you have the capital to do so. But we've seen so many opportunities here over the last couple of years that small little startup companies went out and built very beautiful, nice
Hmm.
storage facilities. They have zero idea how to operate them.
Yep,
They're sitting there 2, 3 years down the road at 20% occupancy. So it's the ground up not work. I don't think it had anything to do with ground up. They didn't know how to look at a market, how to do a saturation report, how to actually do the marketing and leasing activities for the facilities. So while the construction part was perfect, when the other component of that's missing, it ground up won't work either. So I think it really does go back more to the sponsor
yep,
and seeing, can they do every component of it? And then also, is it all in house? Are they subbing all of this stuff out?
hmm,
And that was very important for me to get aligned with our sponsor and offer their products, is everything is in house, nothing subbed out, and 32 years experience doing it. So those were just kind of some of the things that came into my
strong.
mindset of why it made sense.
Strong. Self-storage, small bay, two really strong areas. And at first glance, it seems pretty simple, but what are maybe one or two things that people need to know and that are not aware of underneath the hood that makes it far more powerful than people really realize, or things that are nuanced about it that make something win or don't, would you say?
Sure. I mean, a couple different ways you can look at that. It's actually shocking the amount of people that I'm introduced to today, that my clients send me, that had no clue you could even invest in storage facilities.
Hmm.
They just drive down the road and they see the public storages on every corner and the cube smarts on every corner. But
Yep.
and these are not I mean, we're talking, people in their 55, 60, attorneys, physicians, entrepreneurs had no clue. They've never experienced that that was even an option to invest into out there because they typically are using a financial planner. That's not on their platform, those
Yep.
type of alternative investments, other than, as you mentioned, ETFs, something like that, that they could participate. And those don't really, you're not really a partner in that, from the
Yeah.
ground up. You've got all the overhead of the company. So yeah, it is shocking how it's such a new investment to some people that's been around for 30 years. And then when you really start digging into it, a lot of people, I even had to educate myself on the fact because I
Yeah.
was really single family and multifamily. I wasn't even aware that over the last 30 years, self storage has outperformed every other real estate asset class. That's pretty strong. That's
It's
not
pretty
my
strong.
opinion. That's black and white,
Yep.
data during the last downturn, as we mentioned earlier, back in '08. It was the least affected real estate group. And
Mm.
so I think from what makes it powerful to me is even if we see another cycle like that happen, I feel very confident we may have a very short term downtime, 2 to 3%, single digits, as opposed to, look across the board. Some things were down 20, 30, 40%. So a lot of people, just don't even know it's an investment option out there, but they've never been educated on it. And then I think when you really look into the dynamics of how it's performed over the last 30 years,
Yeah.
makes you wish we were all in it 20 years ago. We'd be having this conversation on the beach right now.
100%. I remember looking at a stat years ago, and whether this is an updated one or outdated one, I thought it was
Mhm.
really shocking. It was 55,000 self-storage facilities in the whole world, and 50,000 of them were in the United States. And so it was a really telltale that we like our stuff.
It is, yeah.
That is a common denominator, that people have stuff and they want to put it somewhere. And there's transitions that take place in life all the time: death, divorce, job switching, et cetera, et cetera. It seems it's more velocity at this point too. But so self-storage makes total sense to me. And what do you think are the driving factors? Demographically, are those the things that you see, or what's your perspective on why this is an outperforming asset class? And even just looking forward in the future with all the changes that are taking place in tech, and how does that stay steadfast from your perspective? I'd love to hear your thoughts.
Sure. No, I mean, those are great valid points. And that's what a lot of people ask. I mean, that's usually one of their first questions is, "Oh, I see it on every corner. How's it sustainable? Is it overbuilt? Did we miss the window?" And I think that's kind of the common theme out there. That's what
Uh-huh.
you would think on the outside, right? As give you an example, where I live here just outside the Dallas market, in my city that I am in, it's crazy the saturation that we have with
Huh.
storage facilities, right? Even me being in the business and familiar with it, I would initially think I would never build there. There's too much competition. It's all over the place. Well, fun fact, I have to drive almost 20 miles just to rent units
Wow.
to park a couple boats and to park a couple extra vehicles that won't fit in my garages. So being on the front line of it, what you just see doesn't always represent the actual availability of it. It's I think then that goes back to really our earlier conversation about picking a sponsor that knows what they're doing, because I do think one of the risks in this is that picking a market that is oversaturated
Yeah.
is, I believe, a risk. And so you really want to be with somebody that has an understanding and inner workings of people on the zoning committees in these various cities that know what's coming down the pipeline. It's not all about driving by and seeing one already built. How do you know one's not already been in the planning stages for a year and a half, unless you've got connections on the inside of these cities? So I think that all goes back to the sponsor and the relationship and how long they've done this. But that's on a go forward demand basis. I also think that's why our model may make a little bit more sense, because I don't
Mhm.
think any of us have a crystal ball to know what the
Sure.
next 5, 10 years is going to hold. What we do know and why we believe right now is the best window that we've seen in a long time is that over the last 2 years, we've seen almost a 50% reduction in new capital spending going
Yep.
towards new construction. Seen as low as figures as low as 40% up to 55%. So we'll just say around 50% less capital has been spent on new construction storage facilities. What that's going to do is that's going to create a window a year, 2 years, 3 years from now that you're going to have a ton less supply coming onto the market. And so we see it as a very, very good opportunity because we're what you consider a merchant builder, meaning we're
Yeah.
not a 5, 7, 10 year hold type play. We are building with the intent to be in and out of it in 3 to 5 years. That
Hmm.
is all we build. So while I don't have the answers short term, I do know the fundamentals have already shown us what's coming.
Yeah.
And so that's really what I like to focus on is what I know, and I know there's going to be a significant less supply chain coming out over the next couple of years that we're trying to take advantage of. And when you look at occupancy, you still look national wise, 90 plus percentage on storage.
Hmm.
That's a very, very healthy number. I mean, those numbers would make me think it's not oversaturated or overbuilt. So if you look at our small bay industrial parks, we have a lot of existing facilities that we built around the Austin area. We're actually at almost 100%, 100% in most, but I think there's some new ones we just now built. We're already at over 80% in just the first 6 months, but we are at 100% occupancy on our small bay industrial parks with the waiting list. So I think there's a huge
Awesome.
demand in that small base sector. And that's a very unique sector that a lot of people aren't familiar with. I actually have to send videos and drone videos and construction videos to my investors that aren't even familiar with that space. And so I think there's an opportunity in that over the next few years too. And our occupancy kind of tells us that it's not a guess. We just go on the fundamentals of what we're already seeing out there.
Yeah. It's really helpful to understand, and we can see why this is your strength and expertise. And obviously, the seasonality matters of investors that are going into things because you just can't rush wisdom when it comes to understanding a particular segment and all that goes into it when you're involved in it day after day after day and seeing all the repetitions of the 10,000 hours and 10,000 iterations that take place in order to grow and change. So I've got one more question before we wrap it up and have people find out how to get a hold of you. What is one thing you do maybe on a daily basis that has been attributable to your own success? Like what's one thing that you do maybe daily that just could be inside, outside of work, whatever that is? I'd be curious to hear.
Probably the biggest learning lesson that I've taken away, and it really doesn't have anything to do with
Sure.
finances, but I think you're probably in a similar position as we spoke a little bit about. Is I think you can't ever underscore the importance of time with your kids. I
Yep.
think you got a very small window before they're out of the house, and we kind of get caught up in the work. And I'm fully guilty of always being accessible to my investors on my cell phone, regardless if we're on vacations. I've been trying to limit that and have a little bit better self control.
Yeah.
But I think that's probably my lesson. If I look back, because my kids now are 13 and 16,
Yep.
and I think if I look back maybe in their younger years, I probably worked way too much, and
Yep.
it's just money at the end of the day,
Yep.
and you can never get that time back. So I think that is. And also, that's what draws me to passive investments, and that's why I
Yeah.
like to educate people about the difference of passive income and the powerful tool that can give you
Yeah.
when you do stop your day job to create that portfolio that you can spend time with your family, grandchildren, children, and constantly have mailbox money coming in even when you're not working. And I think that's the whole key to the balance.
Yeah.
And I've learned that lesson and work on it every day myself.
It's awesome. We are very thankful having you on the show here. How can people get a hold of you, Garland?
Sure. You can always reach out directly on my cell phone number. I'm always accessible. That number is 469-789-9132. You can always shoot me an email. It's just my first name, Garland, at directequitysource.com.
Well, it's been a pleasure to have you on the show here today, Garland. And thank you, everybody, for listening in to Behind the Capital Curtain.